Hello and welcome to tonight's webinar titled Using Stops to Manage Your Trades. I'm Brian Kahn. You can see my new and improved website at jupiterpeakfinancial.com. If you have any questions, you're welcome to email me, and you know that I post almost every day at the IBFX Daily Forex Trading Edge, and that website is there as well. So I duplicate the information from Jupiter Peak Financial over to the IBF website, so either one will get you to the content. I did not post anything today, as this will kind of take the place of the daily market commentary. If you have any questions, as always, please go ahead and type them in. I try and check back on the panel here as I pause and go from application to application, and hopefully you'll be able to get your question in there, and I'll be able to see it and get it answered. I'll leave this disclaimer up just for a few seconds for you to view it. And again, thank you for joining. So some of you, it might be morning, could be afternoon, could be evening. So thank you for finding the time to join me. I will try and provide some good content for you this evening. As always, that disclaimer is in front of you. You're trading leveraged products. Be very careful. And as I always say, trading plans are a must with stops. We're going to be talking about that tonight, and targets, and obviously analysis ongoing throughout that trade from beginning to end. So that fits right in with this disclaimer. An outline, as always, of where we're going, a really quick discussion of the fundamental analysis, the macro and micro events around the world. Technical analysis we'll talk about, and I'll kind of introduce that as we introduce the main topic for tonight, which is stops. Why would you use them, how to implement them, how to adjust them, as I call it, massaging, and a special note on trailing stops. We'll talk a little bit about your opportunity to learn a little bit more one-on-one education, and then a quick review. So we'll jump right into it. This is just kind of my update of what's going on fundamentally, because I think fundamentally you must be aware of what's going on out there in the markets to form an opinion, and then use the charts, the technical analysis side of things, to time the entry, time that location. But fundamentally what's going on, to stay on top of it, I provide that information every day in that market commentary. Your broker is providing information. You can go right to the forexfactory.com economic calendar, which there's a link right from the IBFX website. Obviously, a lot of you have access to CNBC or Bloomberg News, and then obviously other fundamental sites that you take advantage of. So lots going on. Obviously, Europe is kind of in the background now. Trading has been a little bit slower as of late, just because I think that it's a big holiday month, summer vacation, I guess, if you will, the last couple of weeks of it. So trading ranges have been a little bit muted. Movement in all financial markets have been a little bit muted. And you guys, some of you are new. I see some names in here, so some of you haven't joined me before. Just to give you a quick background of myself, I day trade foreign currencies. I also do some longer term trading in foreign currencies. I call it hedging, even though hedging, you have to be careful when you say that, especially in the Forex markets. I'm not talking about hedging intra-Forex markets. I'm calling it hedging to protect against other long-term positions, such as maybe holding the underlying gold basket, or maybe a bunch of gold stocks, or a equity portfolio, because there's been a relationship between equity markets and the United States dollar and various pairs, and how they move out there in reaction to fundamental news and in reaction to other markets. So that's something that I'm very aware of. So that's where I'm coming from, is I'm going to show you actually tonight a nice little relationship between the U.S. Canadian dollar and oil prices, and then how to put stops in to manage those trades. So just a quick background on myself. But getting back to fundamental analysis, overall, global growth is still slowing, but if you're keeping an eye on equity markets, that's not stopping the equity markets from making new highs every single day, basically, and really causing there to be an absence of sellers. So there's really no sellers in the equity markets. And so if you understand that and understand that technically, then you can see maybe some patterns that might be relating to that in Forex markets. So we're always using other markets and fundamental analysis to help us with our trading. But that's my opinion of what's going on out there is no matter how bad economic data is out there, no matter how bad maybe the global economy is slowing, no matter how bad or uncertain things are in Europe, I just think that because there's this push and this thirst for more central bank intervention from the ECB, from the Bank of England, from the Federal Reserve right before upcoming elections, which is another fundamental event, the elections, the presidential elections, not too far off, a few months off here in the United States, the push for that the central banks to help out equity prices is still there, and it's causing us to see a bid in equity prices, and it's causing us to see some movement in foreign currency pairs based on which government is going to choose to weaken their dollar the longest or weaken their dollar the most compared to others. So that's a big fundamental event that you need to be paying attention to as these central banks set their interest rates. Technical analysis, keep it pretty simple. I want to know the trend, which direction the prices are going. I want to be able to read support levels. I want to be able to read resistance levels. And then I want to use intermarket relationships to help me develop trading edges. All right. So keep it simple. Again, I've done other webinars on Fibonacci's and moving average and MACDs, and you can find that all on a link that I'll give you at the end of this presentation. But I still think price action, price action, price action, trends, support, and resistance, if nothing else, that's going to help me to trade in what I call a safe location. It's not guaranteeing anything. I'm not saying I'm going to profit from it. I'm not saying that I can't have a loser. I could very well have a loser, but I think that if I understand trend, support, and resistance, I can limit the size of my losses by using trading plans and obviously using stops that we'll talk about tonight. So there are no guarantees out there. You know that I have to provide those disclaimers. Everything we talk about today is for educational purposes only, and no matter what, and that's something important that I'll talk about a few times tonight, no matter what, even though you put a stop in, there are no guarantees you get stopped out at that price. I think you guys are all aware of that in fast markets. It's easy to forget that because these are not really fast markets right now. Moving forward, why use stops? I'm not really sure I have to explain this one. I think it's pretty self-explanatory. I think that they are critical to your longevity as a trader. I do believe that all professional traders use trading plans and do use stops. A lot of you might be scalpers and day traders, and you might be using stops that stop you out after 10 or 15 or 20 pips. Some of you might be swing or intermediate traders, and you might be getting stopped out after 20 pips, 40 pips, 50 pips, 80 pips. Some of you may be long-term position traders, and you might be risking 100 pips, 200 pips, 300 pips, 400 pips. All depends on what your account size can handle. All depends on your goals, risk tolerance, things like that. Doesn't matter what market you're in. Obviously, IBFX has a link over to TradeStation that has equities and options and things like that. So another great platform there if you're interested in those products. So if you're trading day or swing or intermediate or position and you're trading equities or you're trading options, you still have the right percentages in there as far as what you're risking of that price that you're buying it at, whether it's an option, whether it's a future, whether it's the stock itself. And something about myths. I hear a lot, they got me, meaning they the broker or they the markets. And so I ask every single person who said that before, who said they got me and then turned around the other way. Well, if they got you at a stop or made you, as we call it, puke, it's the point of max pain and you have to get out at that point, maybe, and then it turned around, maybe you should reanalyze and instead of focusing on they got me, focus on why did you get in maybe quote unquote early and maybe at a higher location or lower location depending on if you were short or long, and think about why didn't I get in where it was turning around, and that goes back to support and resistance and trading locations and things like that. So really what I find out as I work with individuals is a lot of the times I'm focusing on people, how actively they're trading and their trading location. And I find out that if I can cut out some of their mistakes, they become a lot more successful of a trader because they're not having those 50-50 trades that might be in bad locations. So just remember, Don't focus on anybody getting you. That's a myth. Focus on you and your locations and making sure you're getting in with high probability locations and managing trades and having good reasons to get in, not just a guessing game. And again, keep in mind, there are no guarantees, okay? Just because you put a stop in doesn't prevent a gap from happening, doesn't prevent a fast market from happening, doesn't prevent us from making mistakes and putting, a stop in the wrong market or whatever it is and forgetting we have an open position. So obviously we have to be on top of our own trading platform and our own trade execution. So stops don't guarantee success. They don't guarantee anything. Obviously, they're just one tool that help us, but there's a lot of other things that go into being successful as a trader. All right, and again, like I said, as I go along and jump into the charts, please ask questions as they come up, and it's a great way for you to get them answered, so don't be shy. So going back into stops here, inserting stops, when to do it, I believe you should be doing it prior to executing the trade, all right? And then how to do it. And again, this is kind of focused on the Forex trader and what I believe are two different types of Forex trader. And I have these reversed, so I apologize. So this should say short term, 5 to 20 pips is suggested. And then it should say long term, so I apologize for that typo there. It should say long term, 75 to 300 pips suggested. Again, this depends on the pair you're trading. This depends on the time you're trading. This depends on the volatility of the markets. That's a big thing. The markets drive us and tell me how many pips I should be risking, depending on if they're volatile, if they're not, depending on if I'm trading when there's active, economic data coming out, or maybe it's a slower time in the day. So the markets drive us and help us create a trading plan. That's really, really important. I'll say it again. The markets tell us how to trade, not the other way around. All right. And I kind of, a good example is a puzzle piece. A lot of people say, okay, I'm here and I'm going to go approach the markets, and the markets are going to have to fit me. And I say, absolutely not. You're a puzzle piece, and there's a puzzle out there, all right, on the table, and you've got to go fit yourself in. You've got to fit yourself into the markets, not the other way around. The markets drive us. I do a lot of work with people with options trading as I'm working with them around their equity portfolio and doing different types of strategies. And there's many, many, many different types of option strategies. And I actually said it in an email today to a client. I said, the markets tell us which strategy to do. So we don't have as many strategies in foreign currencies as we do in options. We have either getting long or getting short, but how long are we going to be long for? How many pips do we think is reasonable and realistic based on the markets? How many pips should we be risking realistically based on the trading range, based on economic activity and volatility in the markets? So I'm really, really big on that the markets tell us what to do, and if you don't give yourself the chance to get that experience and you force things, that's where that frustration can come from. So that's what takes time, is just being patient enough to see the markets evolve and be able to learn from the markets and say, the markets are telling me to do this. The markets are telling me to manage the trade. The markets are telling me to tighten up the stop. The markets are telling me to exit the trade, whatever it may be. So just keep that in mind, that inserting stops is part of a trading plan that's driven by the markets. So I always hit on trading psychology. You guys know that whether I'm speaking in my market commentary or in my intraday comments on the IBFX Connect site, I'm always hammering on trading psychology. And so this webinar, a 30-minute webinar, there's going to be room for fundamental analysis, technical analysis. Our main topic tonight, stops, but obviously trading psychology comes into it. So let me just see if there's a question coming in here. Does your I'm not sure I understand the question, so if you want to expand on that, I don't think I can get it. Does your so I think you're talking about risk rewards. If someone's just asking about the risk reward, stop loss to take profit, how many pips you might risk based on how many pips you're trying to make. And again, the markets will drive that. It's different every time. Yeah, I don't think most people want to be trading with a backwards risk reward where they're trading and risking 8 pips. To make 4 pips, or risking 15 pips to make 7 pips, or risking 100 pips to make 50 pips. So you probably don't want to be backwards. But again, let the markets tell you what's realistic. Where are you getting in and why? Where are you busted out of the trade in your mind, and how many pips is that? And is that a good? Is there enough risk there, and that's warranted to go ahead for the profit that you see there, does the risk reward line up? So that's, again, part of your trading plan. So the risk reward, it could be 1-to-1, it could be 1-to-1.5, 1-to-2, 1-to-3, 1-to-4. All depends on the indicators and the trading plan that you have on that specific, trade and the fundamental and technical analysis behind it. So adjusting stops. I believe that you should be constantly moving your stops as analysis updates. If you're a short-term trader and you're risking 10 pips to make 15 pips and you have a 10 pip gain, think about this, guys, and girls, ladies and gentlemen out there. If you risk 10 pips and you're going for 15 pips, it's a 1-to-1.5 risk to reward, and you have now made 10 pips. If you don't move your stop, you're actually risking 20 pips. The 10 pips that you've theoretically made, going back to zero to your break even, and then the 10 pips that you're originally trying to risk. Now you were saying, I'm originally risking 10 pips, but if I don't adjust things, I'm risking 20 pips. So you might start to move things in your favor. And in these markets that are a little summer markets, a little bit lower volatility, 8 pips, 10 pips, 12 pips might be a very good gain. You're going for 15 pips, it gets to 13 pips or 14 pips, I may very well take off the trade. I might just close it out at market right there because, hey, 1 or 2 pips aren't going to bother me. I'm not going to get mad if I look back and say, oh, I could have gotten 2 or 3 more pips out of it. Again, it all depends on my trading psychology at that time. So that's that message there. Massage the trade as needed. Maybe you're risking 200 pips to make 800 pips as a longer-term trader, and you have 3 or 4 or 500 pips in it. Well, you probably should be adjusting your trade because you don't want to be risking now 500 or 600 pips if you don't move your stop at all. So the markets help us. Technical analysis, fundamental analysis helps us to update that trade. Trailing stops, I wanted to make a quick mention of this because I know that a lot of people, just from my experience of working with people, so many people, say, what about trailing stops? What about trailing stops? Or I use trailing stops. I use trailing stops. I'm not a huge fan of them in the beginning of the trade. Why? Because in the beginning of the trade, if I'm risking 10 pips to make 15 pips, it might move 2 or 3 pips against me. It might move 2 or 3 pips my way. It might just be around break even. And if I put a trailing stop and it moves a few amount of pips and I have my trailing stop on and then it kind of resets and it comes back down, I might get stopped out prematurely. So I do think there's a time and place for trailing stops, but that's when you have a larger winner. Maybe you were going for 50 or 70 or 90 pips and it's been a volatile day and you have 20 or 30 or 40 pips your way, and as you're kind of in keeping an eye on that trade, a fundamental event happens that maybe makes it you more confident of it going your way, and then you start to take out your limit orders or your stop orders, and you go ahead and you move it into a trailing stop. So again, it really depends on first if it's moving in your direction, and then what fundamentally and technically you see that could cause you to say, okay, I'm going to move it from this type of order that I originally had now to a trailing stop order because I think that we might start to trend in my direction. So I really like to see it go first, and then once I have a significant trade in my favor, then I might change it to a trailing stop. So again, everything I'm talking about can kind of fit into any market that you guys are trading. So I don't like the set it and forget it syndrome and just say, oh, the trailing stop will do it for me. I don't have to pay attention anymore. I'm telling you, I think that you should be in charge of your trade from beginning to end. If you're a day trader, you're going to be closing out your trades before you get up from the computer, so you're keeping an eye on it. If you're a longer-term trader, you might be checking in it once, twice, 3 times a day, but you're still paying attention to it. You're not just closing up the computer, going on vacation for a week and hoping for the best. That's not what you want to be doing. You want to make sure that you're in charge of the trade and massaging it as it goes along. So I have an example here. I created these slides a few weeks ago, and things have changed since then. So I originally had the Aussie US dollar and the intermarket relationship example, so we can use that. But since then, I think a better one has even popped up. So from here, I'm just going to pause, so it's a great time to ask questions, but we're going to jump into the technical analysis right now. So the Aussie US dollar we might get to, but we're going to use a different one to begin with. All right, so we're going to start out with just talking about equity markets and giving you this relationship, okay? So I have a couple different equity charts here. One, I always talk about volatility, and volatility driving how many pips I'm going to risk, what I think is achievable, that kind of stuff. So I just want you to see here the VIX. This is using the TradeStation platform. The VIX has been going down, 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 down pretty much all summer. July and especially into August, we're down on our lows. And below that, I have the chart right here. I have the S&P going up, 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 and very close to its recent bull run highs. So keep that in mind. Equity prices are going higher no matter what fundamental analysis is telling us, and volatility is going lower. So just keep that in mind. So as equity markets are going higher, there's kind of a supply and demand relationship. As equity markets go higher, something is getting dragged up with equity markets, and that market that's getting dragged up with equity markets has been oil. I'm not sure if you've been paying attention to it, but what it's been doing since the beginning of July, so the entire month of July and into August, it has been running up, 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 $30, $31, $32, $33, $34, $35. So a $5 move of a $30 stock in a month is over 10%. That's a pretty big move in just over a month, is over 10%. So oil prices, USO, which kind of tracks oil prices have been heading higher, all right? So here are these intermarket relationships. Now that I understand equity markets doing well, I understand that oil prices are recovering and heading back up 89, 91, 93, 94, 95. What is going on with one of those intermarket relationships, the United States dollar, Canadian dollar? So I'm just going to put this on a daily chart for you to see what's going on, and let's look at that same time frame. Here's June, and then July, and into August, and you can see the United States dollar, Canadian dollar, has gone from 104 down to about 99. So it lost about 5 pennies, about 500 pips, as equity prices have gone up, as oil prices have gone up. So there's your intermarket kind of relationship there. I'm going to bring this down to a smaller time frame so that you can see, look what's going on here. Oil prices as of late were kind of going 93, 94, 93, 94, 93, 94, and the United States dollar kept finding support. 99 even it bounced, 99 even it bounced, 99 even it bounced, 99 even it bounced. So if you're saying equity markets are strong, quantitative easing is coming along, probably in America before other currencies, that should weaken the United States dollar against other currencies, and that should hopefully be a boon for the equity markets, be a boon for obviously demand in oil markets and things like that. But regardless, it might weaken the dollar, U.S. dollar versus another currency. So you might set up a trade that takes advantage of this support line being broken. And as you see it being broken, maybe you decide to get short around 99 or 98, 90, somewhere around there. And then you set up your trading plan. Maybe you use the old support is now going to be new resistance. So as you get short around 99 even or just below, maybe you put your stop just above that and you risk 20, 30 pips, whatever it is. And your goal is for this to keep dropping, go 99 even, 98, 90, 98, 70, 98, 60 as it rolls down. And right now it's around 98, 80 or so. So it's about 20 pips below that mark. But, whatever your trading plan is, whether you're risking 10 pips to make 15, risking 20 pips to make 30, risking 30 pips to make 60, you at least have a technical reason here. So this is all done using technical analysis and fundamental analysis. So now we have to go in and set up the trade. So I'm just going to go ahead and right-click here, and I'm going to go to the trade, and we're going to pretend that we want to do this. If it comes back up, maybe we're going to see if it comes back and approaches that line. So we're just going to go ahead and set up a pending order. And I'm going to go ahead and set up my pending order to get filled to be a sell limit. I want to go ahead and sell it. If this comes back up and touches 98.95, let's say. All right, 98.95 is where I want to get filled at. So it's going to have to come up about 10 pips for me to get filled. And if here's now I'm setting up my stop loss. I'm setting up my trading plan. If it comes back up and breaches that 99 level, I don't like it. I thought that it was going to use that 99 level as resistance, so I'm going to give it a little bit above that. I'm going to go to 0.9915. I'm going to give it 20 pips. 99.15 to my entry price of 98.95 is about 20 pips. And I'm going to try and make, let's say, 45 pips. So I'll put in my gain at 98.40. It would be 98.50 if I did 45 pips. So 98.50. I go ahead and I place that trade. All right, and that goes in. So worst case scenario, if this market gets me short, where I want to be short at, I'm going to get stopped out roughly 20 pips away from that. I'm not guaranteed, because it could be a gap, it could be a fast market, whatever it is. I'm not guaranteed, but somewhere around there I should get filled. And then I go ahead and decide how many contracts I want to do and go from there. So I'll expand this out so that you can see the gain side. So that's it. So the green line is where I'm trying to get short, and my red line up top is my stop, and my red line at the bottom is the gain. So that's how I went in and created a trading plan based on fundamentals and technicals, and I put in an entry order where I thought was a good, safe place to get filled based on my trading plan, and I put in a contingency order to get out for a loss and get out for a gain, and I put in about a 1-to-2 risk to reward ratio on that. So that's setting up a plan and using that. Now, would I do this really right now? Not really, because it's in my time zone. I'm getting ready to go to sleep. I'm not going to leave a 20 pip risk to chance, okay? Because 20 pips we know could be done in 1 second. There could be an economic indicator going on when I'm sleeping, whatever it is. So I believe that if you're risking 20 pips to 50 or 60 pips, you shouldn't be leaving the computer. If I'm willing to risk 200 or 300 pips, I'm going to be probably willing to go to bed and see what happens the next day when I get up. So keep in mind, people who are risking 200, 300, 400 pips have to obviously have a pretty large account size to be willing to do that, and they're doing longer-term trading plans for other reasons. Like I said, they might be taking advantage of hedging equity markets, or maybe they own lots of oil, or maybe they're an oil producer and they're hedging markets, whatever it may be. I'm actually taking my Series 3 exam right now, and the Series 3 is all about the futures and commodity markets, and it's all about hedging and speculation and why different people would, or businesses would hedge. So think about if you're right now in the going ahead and trying to sell your corn crop at harvest. You're not going to be able to sell it because there isn't any. You don't have any because of the drought. But if you weren't sure how much you're going to be able to sell it for, then you might go ahead and if you might lock in a price, at one point with someone that you want to sell it with, but then you can always sell or buy futures depending on what you need to do to hedge. So lots and lots of people in the agriculture business, they go ahead and they buy or sell futures to hedge their position or hedge their whatever they need to do, because it helps them with the banks. The banks look at them and say, you're hedged. Now we'll give you a loan so that you can get started on next year's planting and repaying loans and things like that. So lots and lots of different people use these markets not only just to go directional one way for a short amount of time, but they might be hedging their cost of goods somewhere else. You always have to think about that. Think about the bigger picture of what's going on out there, and that can help you fundamentally, because obviously could you go out and trade the corn futures markets or any of these markets? Absolutely. So that's what I kind of want you guys thinking is the bigger world out there of the financial markets and how they all interrelate. And that's where it goes back to that fundamental view of understanding what central banks are doing and setting interest rates and things like that. It's a really, really interesting time, you guys out there right now, because we've never had this much intervention going on where it could happen at any day, at any moment. So that's why stops are important, but trading the right size for your account is really important, because we could have an announcement tomorrow that the Federal Reserve or the ECB is doing something, and a fast market could happen, and stops aren't guaranteed. So that's a great reason to go back to how many contracts is right and not over leveraging your account. I can't stress that enough. All right. So let's just really quickly go to that Aussie US dollar, just to show you what's going on with that as of late. Just like the commodity markets, the United States dollar has been weakening against the Canadian dollar. Take a look at what the Australian dollar has been doing. All right. So their economy has been strong. They have high interest rates, much higher than the United States. The equity markets around the world are recovering. Commodity prices have been recovering around the world. So here you have a very bullish Aussie dollar as of late. So now you have to decide, is it going to keep going to the upside, or is it going to turn around? Maybe you say the equity markets have gone too far, commodity prices have come back too far. I think that oil prices and gold prices, whatever it may be overbought, and maybe you want to short. and maybe you want to short on the longer scale. So if we build a trading plan on the larger scale, because you're a longer term trader, maybe you say, I want to use this resistance here at about roughly 106 even, and I'm going to use these old highs up here to my advantage. So I'm going to build a trade that gets me short if it comes up to 106. So it's going to be a pending order to get short up at that resistance area at 106 even, and I'm going to take advantage of all this resistance up here around 108 even. So I'm going to put my stop way up at 1.0950. I'm going to risk 350 pips here, and I want this to turn around and start going down, and I'm going to try and make about 600 pips or so. So I'm going to have it go back down towards parity, 1 point even. All right, so go ahead and place that trade. And so now you can see where I'm willing to get short, and I'll have to move it out to even a weekly chart so that you can see. So I'm willing to get short up here, just below these resistance levels. I'm willing to get out up here as it really takes out the highest high that it's been to against the US dollar, and hopefully it comes back into its range and comes back down here. That's a very, very valid, trading scenario based on this technical analysis that we're seeing these support and resistance zones. But risking 350 pips, let's face it, 350 pips, if you have a mini contract, right? One contract is $350. Two contracts, $700. So look at your account size and say, can I really risk $350 in my account? Is that a small amount? Don't over leverage your account. So people who are risking these larger trading numbers of pips, 200, 300, 400 pips, they have larger account sizes. So keep that in mind. It all goes back to you as an individual trader and what you're looking for. And to go into that, your opportunity, if you're unsure of how many pips you should be risking depending on where you are around the world and what time frame you're trading in and what foreign currency pairs you're trading in, this is where I provide an engagement interview. That's what Jupiter Peak Financial does. It tailors its education to each individual. So I provide a no obligation, risk-free engagement interview to go through your trading personality. I help you kind of develop your individual situation, and I call it you being the system. Once you understand your system, then you can move forward and I think have a chance for success. So it takes about 30 minutes. It can be done over Skype or phone. If you're interested in that, there's my email and we can set it up, and I'd be happy to go through that with you. Regardless, I give you a nice Word document of what I think is realistic for your account size and the times that you're trading and how much time you're in front of the markets. So you get a nice document based on my unbiased opinion of what you can achieve, and then beyond that you have access to everything else that I provide, and I'm going to give you those links in just a moment. So to review, we talked about my opinion of fundamental events, how to stay on top of that, use the Daily Forex Trading Edge or my website each and every day to get my commentary on there. Technical analysis, keep it simple, use your trend, use your support, use your resistance. If you want to go into deeper subjects, then you can go into the IBFX videos that I've provided out there on their YouTube site. Stops. Why would we do them? Again, I didn't really want to explain that too much because I think it's so imperative. How to do it. I use the MetaTrader 4 platform there. How to do it depending on if I'm a long-term trader or short-term trader, and massaging the trade. Again, I talked about that as it's moving my way, maybe turning into a trailing stop, maybe adjusting how many pips I want to risk, maybe even legging out and taking some of my profit off the table if I do have profit and lightening up, and then moving my stops as I need to. So legging in, legging out, those are common terms. And then we talked about, again, no guarantees with stops out there depending on how active the markets are and gaps and things like that. And then again, I mentioned your opportunity I provide time for you to get grounded and focus on your individual situation. So ongoing help. Next week we'll be doing a webinar in about 2 weeks. The main topic is going to go into, it's been determined, it's going to go into minis, micros, demo accounts, and standards, which one is right for you. So I'll give you my opinion on that. But here's the education and the recordings that I provide. Again, IBFX wants you to be educated. They have a great education site. I provide information every day on the Daily Forex Trading Edge. Also, you can go to my website to find that at Jupiter Peak Financial. I also download these videos once they go through compliance at IBFX. They'll be on their YouTube site. There's about 24 videos on various topics already there, so please go to the IBFX YouTube site. And then I do try and go ahead and comment intraday on that Connect page, the IBFX social site, when I get a chance and see things going. Honestly, I haven't been commenting that much lately. Because it's been summer markets. I got back from vacation recently, and it's just a pretty slow time the next few weeks. I think we will start to see activity pick up. So right there, that is trading psychology. I understand that it's a very slow time. I understand that equity markets are in tight ranges. That goes and kind of moves over and helps me decide how frequently I want to trade, how many pips I want to risk, how many pips I'm going for as far as reward goes with my trading plans, by understanding how volatile these summer markets are right now. And just honestly, they aren't that volatile. So don't beat yourself up right now in these markets. Keep your powder dry, as we say, and be ready for good volatile markets when they return. So there still are opportunities out there. You just have to be very patient to wait for those. All right, so thank you very much for your attendance tonight. Hopefully that was helpful in hearing it from me as far as how crucial I think that stops are and when they should be implemented, which is prior to entering the markets. That should be developed. That's the main thrust of the material tonight. So thank you very much. I look forward to seeing you on the next webinar in 2 weeks. And please reach out in between if you have any questions, and please take advantage of all of this great education that IBFX is providing you. Have a great evening, morning, or afternoon, depending on where you are around the world. Thanks. Happy trading.